did very basic lecture on this consolidation, the first lecture. Now today we are doing it for the second lecture. I picked up some very basic questions. Okay, so these are not the questions which really are very difficult, but this is the starting point. Okay, but we need to just make sure that we understand the basics. Now remember what happens that in your consolidation you've got consolidated statement of financial position, and you will have consolidated statement of comprehensive income. And we will be starting with the financial position. And when you talk about financial position, of course, you need to produce a consolidated balance sheet. And for example, there is a parent company, there is a subsidiary, or then you have to produce a group accounts. Or might be there is one subsidiary and one associate. So a parent and a subsidiary, which is the control relationship, and an associate, which is significant influence. And then you have to make consolidated financial statement here. So, and of course, when you do this SOFP consolidation, any type of transactions could happen. For example, a consolidation question could involve IFRS 9, which is financial instrument, because parent has some financial instruments or subsidiary have financial instrument. It could, engage IAS 19, employee benefit. It could engage IFRS 2, share-based payment. There could be one adjustment related to provisions. Probably there is some adjustment related to, for example, IAS 38 or whatever. Fair values were there, evaluation. So a lot of things will be there, but not always. I'm not saying that every consolidation question will have all of these things involved. No, if they are putting financial instrument, they might not put leasing. They might not put leasing. If they put lease, they don't put this one. If they are putting an adjustment for IAS 19, maybe IFRS 2 is missing. So some of them will be there and some of them will not be there. But there are a few things which will always be there. There are a few things which are always there. So first we need to understand, and I call them. So what happens that we start making, there are typical items which you need to find out or which you need to calculate in order to make a consolidated balance sheet. For example, whenever you do, some parent is doing some acquisition. So one thing is very common, which is called goodwill. So that goodwill we have to calculate. Now what is goodwill? We are going to discuss it in some time. Then if you remember, we talked about NCI. So you do one working for non-controlling interest, you do some fair value adjustments, we do parent retained earning, and we do some, for example, fair value adjustment, NCI, goodwill, parent retained earning, NCI consideration you need to calculate. So there are 6 workings. I call them big 6. I'm sure you guys know big 4, the audit firms. That's a different thing. The big 6, which I call, it means that these are the 6 calculations, or there will be 6 line items or 6 workings, which you always need to produce, which will always be there in your consolidated financial position. After that big 6, there might be a 7th item, there might be an 8th item, might be a 9th item, or a 10th working. So 7, 8, 9, 10, even 11, even 12. It could continue, but these 6 will always be there. So we will start from there. Am I clear?
Yes, clear.
Now, before we start seeing or doing this question, which are of course very easy, I just want to make sure that we understand a few terminologies. So one thing which I want to make sure that we understand, what is net assets? Can somebody tell me what is net assets? Yeah. So net assets are actually called your total assets minus total liabilities. This is called net assets. Total assets minus total liabilities. If you see your balance sheet, on balance sheet you've got non-current assets, you've got current assets. So actually, I should have been doing it on my PDF annotator so that I could keep it here. So let me finish this thing and then I'll change the software. I'll move to PDF annotator so that we can, because in Excel it will be removed, but in PDF annotator we can see that. Okay, so let's suppose that you've got non-current assets for 1,000, you've got current assets for 500, your total assets are 1,500, and here you've got your non-current liabilities, which are 500, you've got your current liabilities, which are 200, and of course you have here your equity, and you know that equity consists of share capital, share premium, retained earnings, and reserves. So in order to make it 1,500, you've got equity, which is 800. Okay, this is how you make the balance sheet. By the way, equity, let me write down. It consists of 4 items: share capital, then it has share premium. Share premium, of course, share capital, you understand the value of the ordinary shares which you have issued, the face value, the nominal value of the ordinary shares which you have issued. Share premium is when you are actually issuing shares at a price higher than the face. Share premium is like, for example, if there is any share which has a nominal value of $1, face value of $1, and the company, not anyone else, the company, first time when they sell it for $3. So they are selling it for $2 more. That extra $2 is called share premium. So you would write down $1 in share capital, and you will write down $2 in share premium. Then you have got retained earnings. Retained earnings, these are called undistributed profits, like whatever profits you have made in last year, and now you have, you give out the dividends, but after giving dividends, whatever is remaining, that is called retained earnings. After retained earnings, you have got here reserves. Reserves, we have revaluation reserves or some other reserves, whatever. So these are the 4 components of equity, which is here together 800. Now, if I see what are my net assets, so according to this definition, my total assets are 1,500 and my total liabilities are 700, which means that I come to the answer 800. So it means that net assets are 800. But then you notice that equity is also 800. So it means that net assets and equity is the same thing. So you can say that net assets is equal to equity. It is the same thing. Whether I call it net asset, whether I call it equity, it's the same thing. Now, okay, we understand the definition. Now, but what is it exactly? What is it exactly? If we try to understand, so you can consider that this is the book value. I'm not saying the market value. This is the book value of shareholders' wealth. Because you have assets of 1,500 and you have liabilities of 700. So you will sell all the assets, you will pay the liabilities, 800 is remaining, and this belongs to the shareholders. So equity belongs to the ordinary shareholders, not preference. Equity belongs to the ordinary shareholders. So equity is the value of the company. You can consider it as value of the company as per the books. Like if this is a business, Alpha company has $1,500 of assets, 700 liabilities. We will sell the assets, we'll pay the liabilities. What is remaining? 700. So this 700 is actually the book value of the business. I'm not saying the market value, because the market value will be established by the market price of the share. Here I include the nominal value of the share, $1. So within equity, within share capital, you are putting the nominal value of the shares, not the market value. So this is the book value of the company, book value of the business. So if you ask me that there is a business which has net assets, or let's call it like this, there's a business which has total assets, 1,000, and it has total liabilities, say 300. So what is the value of this business? So I can say that the net assets are 700. So the book value of this entity is 700. Are we clear until here? And this actually belongs to the ordinary shareholders. You remember we have been using the word residual interest. So this is the residual interest because we have paid all the liabilities, and this is the amount which we can ultimately hand over to the shareholders according to the balance sheet. What is market? That's a different case. Now, let's suppose that there is a small restaurant which you want to purchase. Give it a name. I don't know, Garden. The restaurant name is Garden. I like this name. It has total assets of 1,000 and it has total liabilities of 700. And let's call them, this is, I don't know, 1 million, this is 700,000. So 300,000 is the net assets. You go there and you say, I want to buy this restaurant. It's a rented place. Before he was giving rent, when you will purchase, you will start paying rent. So property is not owned. So you see what you have inside. He has got some tables and, furniture and kitchen utensils and cooking, utensils, refrigerators, etc. And you would ask him that, how much do you want? And he says, I need 1 million. Or maybe he says that, I need 500,000, I need 500,000. And you will say, see, your balance sheet has only 300,000 value because you have got assets. What are your assets? You've got tables, you've got chairs, you've got some refrigerators, you've got some cooking utensils, some cutlery, some crockery. It's not 500K. Why should I give you 500K? And besides, your balance sheet shows only 300. You know what he will tell you? He will say you that, Rajesh, I'm not selling you furniture and I'm not selling you refrigerators. If you want to buy furniture, you can buy from the market. If you want to buy refrigerator, there are so many companies. Go and buy from Samsung. Go and buy from Philips. I'm not selling you refrigerator. I am selling you a business. I'm selling you a business which has been promoted for so many years, a business which has got its own customers, a business which has got its own people and its own team, a business which has got its own internal processes, a business which has been advertised in so many people, they know us. If you take key from us, tomorrow morning when you will open the restaurant, customers will start coming in without any effort. So I am not selling you assets individually. I'm selling you a business. Remember, if a business goes in a very bad shape, which is like you call it bankrupt business, which has busted, then businesses are sold on assets. You start paying off because this restaurant owner will tell you that if I had to get 300, I could go and start selling table to someone else and chairs to someone else and refrigerators to someone else. I'm giving it as one package. So the value of the business, if you take it from the balance sheet, this is that business which is like almost closed, almost dead, and you start buying it in kilos. Okay, this is buying it in kilos. But as long as the business is running, no matter whether it is good or whether it is bad, it definitely will have some value more than 300. More than 300. So he says that I know that my net assets are 300,000, but I am claiming this 200 extra. I am claiming this 200 extra. And that 200 extra is because I'm giving you a brand. I'm giving you a business. I'm giving you an established entity. And you need to pay for that. Otherwise, you start your own restaurant, you start hiring people, you start making your processes, you start making your recipes, you start doing promotion and make your customers. It will take you 2 years. I'm giving you a 2 years head start. And for that, I need 200,000. And you would say, 200,000, I understand what you are saying. It makes sense. But I think 500K is too much. Let's make it 450 and we make a deal. And if you both parties agree that, okay, let's pay 450, you shake hands. So actually what happens that you are paying 150K more. 150K more than what? More than the net assets. And this is your goodwill. This is called goodwill. So if you speak about goodwill, there is one general understanding that goodwill is something. Goodwill is what? It's a good reputation of a business. Goodwill is what? Goodwill is, it's the relationship between a business and its customers. Goodwill is the ability of a business to attract customers. I mean, these are different ways of saying it. It's the reputation of the business. It's the good relationship that exists between the business and its customers. And goodwill is the ability of a business to attract customers. Goodwill comes from where? It comes from good products and it comes from good service. Not only good products, but also good service. I mean, you will see there are so many banks who do the same job. You have got two banks near you, A bank and B bank. And you say, you know what? I want to go to A bank. I don't like B bank. They both provide the same service and they both charge you almost the same money for the same kind of transactions. But you like bank A. You know why? Because when you go to bank A, the people sitting there, they give you a smile, they offer you a seat, they ask you how are you doing, and they try to help you. But in bank B, when you go, they say, please stay outside in the line and then go to this window and then go to that window. That's why you don't want to go there. So sometimes goodwill comes from product and it also comes from the service. The same happens with restaurants, the same happens with banks, the same happens with all other businesses. In any case, this is the existence of that relationship between the entity and the customers. But how do you value this? Now we know that there is some goodwill. We know that there is some goodwill. There must be something which exists, but how much it is? The answer is that goodwill is actually, so we come to the conclusion that goodwill, if we have to, so it's a subjective thing. You want to make it objective, then it is the difference between the consideration. So we call it consideration. Let me write a little bit smaller because I'm writing too big and I don't have space left. Goodwill is consideration. Consideration is the price which you pay. Consideration transferred, we use the word transferred, minus the net assets. Minus the net assets. So if you transfer consideration 450K and net assets were 300, your goodwill is 150K. This actually is over and above what you pay than the net assets. Are we clear on this thing?
Yes.
Okay.
Yes.
Now, goodwill cannot be estimated or established before the time of sale because goodwill will depend on the negotiation skills of the two parties, the urgency and the need of these two parties. If the guy really wants to sell it, I could push him down to 400, because he needs to sell for some reason. So he is willing even to give it for little amount. So goodwill is only realized, it is only realized at the time of sale when both parties agree. Now there are two types of goodwill. We call it purchased goodwill. Purchased goodwill. And you call it, purchased is also called acquired goodwill. Acquired or purchased are same word. Or you call developed goodwill. Developed goodwill mean like when this guy who was running this restaurant, in his books, if you remember that he had assets of 1,000 and he had liabilities of 700. He was not adding this goodwill number 450 or 150 here. He was not adding. He cannot, because there is no evidence for that. He has done some efforts. He has developed his business, but he cannot quantify. So developed goodwill is never shown in the books. Developed goodwill is never shown in the books. Purchased goodwill will go into the books. The goodwill which is, how to say, purchased, that goes into the books. Because why do we say that? Because for you, let's suppose that this is Rajesh. So what is happening? You are paying out $450,000 to acquire the restaurant, and what is coming to you is only $300 of net assets. Your debit credits will not be equal because you will make cash payment or whatever. 450 will go to you outside, and what comes inside is only 300. What comes inside for you is only 300. So your debit investment or debit assets, whatever, is 300, and you have credit of 450. So how do you supposed to equate it? Because here you will write down debit goodwill 150. So you, the buyer, the purchaser, will record the goodwill as a debit amount, for example, in 150 in the consolidated financial statements. This will go to consolidated financial statements. Remember, let's suppose it's very important. There is a company P which purchases company S. At the time of purchasing, P company paid a goodwill of 150. In the individual financial statements of P, they will never show goodwill. They will write down they have an investment of 450, which they paid. But in the consolidated, when you make the group accounts, in group accounts, you will write down goodwill. So always remember that goodwill appears in the group financial statements. So goodwill is what? Goodwill is paid at acquisition. We call it acquisition. So acquisition took place on a certain date. For example, 1st January, you made this deal. So 1st January 2020 is called the acquisition date. And on this acquisition date, you paid 150,000 more. And in the group financial statements, it will be called goodwill at acquisition. Individual company will not show goodwill. It will go into your group financial statements. It is a consolidation item. Goodwill is only shown at consolidation. And the name we give it, we call it goodwill at acquisition. How much it is? It is 150K. And it goes into your non-current assets, okay? You've got PPE. After PPE, you write down some other assets, and then you write down goodwill at acquisition, 150K. Now, now it is an asset. And it is actually, if you consider that it is actually an intangible asset, but it does not come under IS 38. We have intangible asset standard IS 38, but we do not show goodwill under IS 38. Because IS 38 will have a different treatment. Because IS 38, your intangible assets, IA, we will amortize them. We will amortize them, okay? And those assets, actually, they have to be identifiable assets. The assets which you put in under IS 38 are those which are identifiable. We use the word identifiable means that there is a contract to verify. I purchased the software, I got a contract, I made it, somebody gave me an invoice, I made the payment. So you ask me, do you have this software? Yes. What is the evidence? This is the contract, this is the payment. But for goodwill, do you have an identifiable, is it an identifiable asset? The answer is no. And we don't put it under IS 38. In IS 38, you do have some internally developed assets. So some assets you are buying from outside, a software, which is identifiable, but it is possible that you have some intangible assets which you developed inside by paying salaries to your staff. So should you recognize, do you recognize those assets as well internally developed? Answer is yes. But condition is that their amount must be verified by a third party. So you've got a customer list, which is an intangible asset under IS 38. So do you value it? If only it is verified by a third party. If you have done proper valuation, yes, you can book that asset also. Anyways, we are not talking about IS 38. Coming back to goodwill. So goodwill is not treated under IS 38. This is your IFRS 3 business combination. Now, since it is an asset and it is treated under non-current asset, do we depreciate it? Answer is that we do not depreciate it. We do not amortize it. We only do impairment. So end of the year, and you remember, always remember one more rule. All those assets, I'm putting a very specific focus. All those assets which are not depreciated, they must be reviewed for impairment. Impairment review is a compulsion when you are not doing depreciation. Because if you are doing depreciation, so you are bringing assets from 1,000 to 800, from 800 to 600, you are already decreasing the amount of the asset. So impairment is important, but it is not a compulsion every year. But for those assets which you are not doing depreciated, which you are not doing depreciation, you can't keep them like this, okay? It is not possible. So because goodwill is not depreciated, therefore it must be checked for impairment every year. And in case there is an impairment, then you subtract that impairment and you say, now the goodwill is only 100K. And here there is one more issue. If you remember that there was a concept of reversal of impairment we studied. So reversal of impairment, it applies to other assets. In case of goodwill, reversal of impairment is not allowed. Reversal of impairment is not allowed. So goodwill, we know how to calculate it. We know that it is going to be on my balance sheet under my non-current assets, and I'm not going to amortize it or depreciate it. But however, I will check for impairment every year compulsorily. If there is any impairment, I will record that impairment as an expense in my P&L, and I will decrease my non-current asset 50, for example, in the balance sheet. But it can, if it has come to 100, there is no possibility that you take it up. Reversal of impairment in case of goodwill is not allowed. Are we clear until here?